Hey, what is going on, everybody? Welcome to another video in which we are going to see savings account basics you need to know and how interest is calculated on the money present in your savings account. So let's get started with this video. Most of you underestimate your savings account mostly because of low interest rate that it provides. But if you see, apart from the interest rate, there are many other plus points of savings accounts which are mostly ignored. Before going to the pros and cons of savings accounts, let's see what exactly it is. A savings account is an interest bearing deposit account held at a bank or any other financial institution that provides a modest interest rate. You can open a savings account in any bank with the help of your identity and address proof with couple of your passport size photographs. Some of the banks or financial institution may want you to maintain a certain average monthly balance in your account. They might also limit the number of withdrawals during a month. Coming to the interest part, most of the savings accounts in India provides an annual interest rate of 4%. That means one day interest will be 4% divided by 365 days, which comes to around 0.011%. Remember guys, interest on your savings account is calculated on daily basis using the lowest balance for that particular day, and most of the banks credit this interest earned at the end of the quarter. So you can say that compounding is done quarterly in case of savings accounts. Now let's see interest calculation with the help of an example. If Raju have rupees 50,000 in his savings accounts, then the interest that he will be earning in one day, considering 0.011% interest rate in a day that we have seen previously, the interest will be somewhere around rupees 5.5. This is calculated as rupees 50,000 multiplied by 0.011% divided by 100. So interest for 30 days would be 5.5 multiplied by 30, which comes to around rupees 165. This is how the interest is calculated if the amount is fixed for 30 days and later it is compounded at the end of the quarter. Now let's see how interest is calculated based on periodic deposits and withdrawals in your savings accounts. Let's say Raju have rupees 50,000 for the first 10 days of the month and then he deposits rupees 20,000 on the 11th day. So the interest calculated for first 10 days would be somewhere around rupees 5.5, considering 0.011% interest per day on rupees 50,000. But since the interest is calculated on the lowest balance for that day, 11th day interest will be again calculated on rupees 50,000, which would be rupees 5.5, and then from 12th day onwards the interest would be calculated on rupees 70,000. Now let's say Raju withdraws rupees 30,000 on the 21st day of the month. So the interest will be calculated on rupees 70,000 from 12th day to 20th day of the month. Since withdrawal is done on the 21st day, lowest balance will be taken into consideration, which would be rupees 40,000. So that's the way how interest is calculated on your deposits and withdrawals from your savings. Remember, lowest balance is taken into consideration to calculate interest for that particular day. Now, since you have understood the definition of savings accounts and how the interest is calculated and compounded for fixed as well as variable deposits and withdrawals, let's see the advantages and disadvantages of savings accounts. So, advantages are liquidity. You can withdraw your money anytime you want from your savings accounts. Emergency fund. It is very much useful as you can keep your emergency fund in your savings accounts. Interest earned. You earn interest on the money present in your savings accounts. Exemption under ATTTA. This is one of the most important feature that it provides. Any interest earned in savings accounts is exempted from tax and deduction is made under ATTTA section. So no need to pay any tax on the interest that you earn in your savings accounts. But the maximum amount of deduction that you can make under ATTTA section is rupees 10,000. Now let's see what are the disadvantages. Low interest rate. The interest rate applicable is low compared to some other bonds or CDs. Easy access. Since it is highly liquid, you withdraw money even if it is not necessary. So these are some of the things you should know about savings accounts. It is very much useful if you consider it as your emergency fund, provided you don't withdraw your money unnecessarily. Feel free to comment in the comment section in case of any queries. Don't forget to subscribe to this channel, like and share this video. Stay tuned.